All right, good afternoon, everyone, and welcome to today's headline roundup. I know we've got a lot to cover today, so Dennis, let's just kick this thing off.
Mark, thank you. Hey, welcome everybody. It is October. Today is October the 3rd. Have a lot going on. There was a lot going on overseas last week. A lot happening here. I'll get the video off to save some bandwidth, and we will go ahead and jump in. Quick reminder, next week we will be recorded. The following week we will be back live. So October 10 will be recorded. October 17, we will be live. So just a quick look ahead so you know what to expect. A lot of headlines this week. The United Kingdom may have had their Lehman moment this past week. Lehman was the catalyst for the market downturn at the time of the great financial crisis. I'll give you details momentarily. It relates to UK pensions, and it seems that U.S. pensions might be next in line. I've been talking about that for a while. With the Fed's easy money policies and artificially low interest rates, it's put pensions in a very precarious situation in that they're still using actuarial assumptions, assuming they're going to make a return on investments that are really much higher than what the actual returns can be. So that's created a big disparity between what they actually have to pay benefits and what they have promised as far as benefits go. And to try to make up the difference, as we've reported here in the past, many pension funds are now using leverage. They're borrowing money to try to get better returns. Well, that blew up this past week in the UK. So I want to spend a little bit of time talking about that. Really hasn't been, from at least my research, hasn't been widely covered on mainstream media. Stocks, of course, not doing well. The Dow, anyway, is on track for the worst year ever. This past week also, after announcing a student loan forgiveness program, the Department of Education changed the rules, disqualifying people that had, prior to that ruling, qualified for student loan forgiveness. And inflation is still running hot by the Fed's favorite measure, and I thought I would take a minute to talk about gas prices by state. So a lot here this week. Alistair MacLeod commented on the UK's Lehman moment. He wrote a piece called "The Crisis is Upon Us." This was actually published on September 30. And he starts by talking about the fact that gold and silver benefited from what happened in the UK last week. He starts his piece by saying, in an extraordinary week of turmoil in global bond markets, gold and silver rallied. In European trade this morning, gold was at $16.72, up $28 from Friday's close, and silver at $19.16 is up 31 cents. And you can see the chart of gold and silver priced in US dollars. The big news this past week was the collapse of the UK's gilt market's long maturities. Now, for those of you that are not familiar, a gilt is a name for United Kingdom government bonds. The Bank of England had to intervene. They had to become a buyer of last resort of these UK bonds. They bought 65 billion pounds in long gilts on Wednesday. Now, that alone is a little bit alarming, that they had to literally create currency so there would be a buyer of last resort for UK government debt. That alone should be a bit alarming. But the rest of the story is that this situation came about because pension funds were leveraging their gilt portfolios through interest rate swaps and repurchase agreements up to 7 times in an attempt to match their actuarial liabilities through liability-driven investing. With over 1 trillion pounds outstanding, a doom loop of selling to meet margin calls was an emerging crisis which had to be stopped. So to attempt to maybe put that another way, all these pension funds have been basically borrowing to invest, taking advantage of low interest rates to attempt to boost pension yields so they can meet their ultimate pension obligations. As interest rates are increasing to fight inflation, it puts pensions in a very awkward situation, and they reached a point that there were margin calls. They had to sell assets, and there were no buyers for these assets. So the Bank of England stepped in and bought 65 billion pounds in long gilts. I expect that we will see more of this. Now, if you have a question, I don't believe I pointed this out at the outset, but if you have a question or a comment, please go ahead and type that in the box on the right-hand side of the screen, and I will do my best to answer that. Cloud says it's been a wake-up call for investors who are not even aware of LDIs, liability-driven investing, let alone the Lehman moment they brought about. LDIs are also common in the EU, the European Union, and the US, the United States, so the problem is unlikely to be confined to London. I agree with Alistair. I believe we are going to see more of this. A pause for thought has stopped the headlong rush out of all currencies into the dollar. Now, what you see that Alistair has published here is a chart of the U.S. trade-weighted index. The dollar relative to other fiat currencies has been strong. The U.S. dollar index has gone from under 100 to over 110. But now you're seeing that that may be changing. Perhaps the dollar has peaked. Now, it really gives you some perspective as to the health of the euro and the yen and other fiat currencies when the U.S. has rampant inflation, and yet there have been a lot of investors and institutions that are moving out of yen, out of euro, and moving into dollars because, as we often state, it's the best house in a bad neighborhood. It's the cleanest dirty shirt in the hamper, but now that might be changing. From a peak of 114.78 on Wednesday, the trade-weighted index has backed off to 111.61 this morning. McLeod says it's too early to say the dollar has peaked, but bearing in mind the weight of speculative money that's long dollars and short everything else, the chances of a significant reversal are high. Gold and silver, as McLeod already commented, have benefited. Both metals are heavily oversold on COMEX, with hedge funds net short over 8,000 silver contracts. A silver contract controls 5,000 ounces of silver. That's 40 million ounces of silver net short. And there's a net short 36,695 gold contracts. Since September 20, when this data was reported, McLeod speculates that these short positions have probably increased. COMEX is finding a remarkable level of contracts being stood for delivery. So traders on COMEX are saying, I don't want to take the cash for my contract. I'll take the gold. I'll take the silver. McLeod says in this month alone, in the month of September, 37 tons of gold have been stood for delivery. That's 37 tons of gold that futures contract sellers have had to come up with because the buyers said, I want the gold, I don't want the cash. This indicates that while hedge funds are playing their games and bullion banks are suppressing prices to recover their shorts, a mixture of high net worth individuals, long-term investors, and perhaps minor central banks are cleaning out the market of physical bullion. I expect that these conditions may be the catalyst that we'll finally see gold and silver react the way we've been expecting them to. The conditions for a massive bear squeeze, similar to that between March and August of 2020, now appears to be in place. Now, for those of you that maybe don't recall what happened, we saw really over that period of time, gold go from about 1,400 an ounce to about 2,200. McLeod says that bear squeeze that we saw in 2020 now seems to be ready to potentially repeat itself. Anecdotal evidence is that ordinary people around the world are now worried enough to clear out retailers of coin and small bar stocks. As we've been talking about here on these headline roundup newscasts, as well as in the Portfolio Watch newsletter and on the podcast, there has been a growing disparity between the physical price of metal and the paper price of metal. With the rise in interest rates and bond yields just starting, a crisis has already occurred in UK gilts and pension funds. Consumer price inflation heading everywhere to over 10%. That is the norm now in Europe. And promising to stay there confirms they are still far too low. Keep in mind, you can't really get inflation under control until you have real positive yields. And with inflation over 10%, and that's the officially reported rate, interest rates have to be at least that to have a chance to get inflation under control. So McLeod, I believe, correctly points out that there will be more crises to follow involving swaps and repos in addition to bank credit contraction. Increasingly, those wanting to get out of an imploding fiat credit system are turning to real money, which is only physical gold and silver. Now, it begs the question that perhaps U.S. pension funds could be next. Are we going to see that happen sometime soon? Well, this is from Quote the Raven, which is a blog that I do follow. And the author had the pleasure, he writes, speaking with Jason Burak from Wall Street for Main Street, and offer his updated thoughts on the Federal Reserve, the economy, and state of the world in general. The first thing they talked about was Fed policy, which I told Jason I thought was a case of too much, too late. I think it depends on your perspective as to whether or not you say it's too much, too late. I think given the slowing economy, there's no doubt that the economy is contracting. In fact, the October special report is titled Anatomy of a Recession, Strategies for Today's Economy. And it talks about the fact that we are in a recession, and raising interest rates into a recession only makes the recession symptoms worse. So he made the argument that the Fed is, as it always does, overshooting its mark and doing so at the wrong time. I would certainly not disagree with that. This, as I have written several times, is why I believe the market's going to be in for a serious crash at some point within the next several months. I reiterated my stance to him that the economy and stock market have not yet truly digested 3% interest rates, and when they do, there will be hell to pay. I also talked to Jason about why I think equity markets wind up 30 to 40% lower from here easily. Now, in the October special report, I go back and refer to the Buffett indicator. The Buffett indicator takes the total value of stocks and divides by the U.S. economy to give you some perspective as to whether stocks are overvalued or undervalued. Despite the fact that the S&P 500 is down about 25% year to date, stock valuations are still higher than they were at the time the tech stock bubble started to unwind. So a 30 to 40% decline from here would certainly be within the realm of what we've experienced historically from these valuation levels. And we said if the Fed does decide to pivot, if they decide to reverse course, if they decide to go back and pursue easy money policies, it would be a different story. But for now, with the Fed holding course, I think it's inevitable that our markets run into a brick wall relatively soon. Now, he talks about why he thinks that, and the Bank of England has restarted currency creation or quantitative easing, and I believe that's going to make the Fed do the same thing. Now, he goes on to talk about the fact that U.S. pension funds could be in the same amount of trouble that UK pension funds are. He references this Bank of England intervention that I started with, and he talks about the fact that that was a result of pension funds potentially having a Lehman moment. The Bank of England stepped in and created a bunch of currency because the alternative was far worse. Pension funds would collapse, there would be a failed potentially bond auction, and things would start to unravel. Reports noted that pension funds overseas were hastily selling bonds to try and meet margin calls, a scenario I'm certain we're not far off from here in the U.S. Pension schemes had been selling gilts to meet emergency collateral calls or reduce exposure, pension advisors said. There are schemes running out of cash at the moment, one pension consultant said before the Bank of England intervened. This is from the Financial Times. At some point this morning, I was worried this was the beginning of the end, said a senior London-based banker, adding that at one point on Wednesday morning, there were no buyers of long-dated UK gilts. It was not quite a Lehman moment, but it got close. I told Jason yesterday that I don't think the U.S. is far off. All I've been reading over the past 5 years is how pension funds here can't meet their targets despite the market ripping. So despite a significant bull market up to this point, pension funds have still not met their earnings target. And to compensate for that, they were taking on leverage. They were borrowing money to invest. The fact that these funds were unable to post the returns that they needed during arguably the most euphoric bull market in history should concern us. When conditions get worse for managers like these, like they are now, the capital destruction could be devastating. And I think we're now seeing the beginning of that. Stocks now are not providing a terrific environment for pension funds or individual investors. And again, as I go through the material today, if you do have a question or a comment, go to the questions box. I am taking a look at that now. Chris, thank you. He said your Lehman moment explanation for the UK was great. After reading a bunch from other sources, I was confused. No more confusion. Well, Chris, thank you for the nice words, and I'm glad that helped. If anybody else has a comment or a question, please go ahead and type it in the questions box. So it was the worst September for stocks since 2002. This is from Market Watch, and for the record, whenever I read something on Market Watch, I personally believe they have a bit of a bias as to how they present information. So I always try to use the information I get here appropriately. It was a September investors will remember, and not in a good way. A Friday drop left the S&P 500 and the Dow Jones Industrial Average with their biggest monthly losses since March of 2020. It was the worst September performance for both indexes since 2002. And for those of you that subscribe to our Portfolio Watch Positions program, you will see now that our sector rotation portfolio is now 100% cash, meaning that now even the utility sector of the stock market and the energy sector of the market, which had been holding it up, are now collapsing as well. So we have all 11 market sectors by our measure now with negative momentum. So seasonally inclined investors may wonder what that means for October. Well, the S&P 500 fell 9.34% during the month of September. The Dow fell 8.84%. The NASDAQ fell 10.5%. Not counting the current month, the S&P 500 has seen a September decline of 7% or more 11 different times, going back to 1928. So historically speaking, not a great month. The Dow has dropped 7% or more in September 13 times, and the NASDAQ has suffered a fall of 9% or more 6 times, going back to 1986. I think it's reasonable to point out that there have been more big declines since the dollar became a fiat currency than prior to that time, and that, in my view, is not a coincidence. Dow Jones market data found that in Octobers that follow a 7% or larger fall in September, the S&P 500 rises 0.53% in October, and the median gain is 1.81%. Well, October is historically not a great month, and after a big decline of 7, 8, 9, or 10%, you would expect that markets would consolidate. So I think that's really what these statistics are telling us. October is also associated with historical market crashes, including those in 87 and 29. Dow Jones market data, meanwhile, found that in October's following a September drop of 7% or more, the Dow fell in the following month, averaging 1.51%. So we'll have to wait and see, but the Gateway Pundit reported that Trades Academy noted that the Dow and the S&P 500 are both now at bear market lows. The Dow is having its worst year ever. If this current pace keeps up, it'll be the worst year for the Dow in history. So we'll have to wait and see. But certainly Fed policy, which has really allowed these markets to thrive on an artificially financially lubricated environment, to use that term, are now going the other way as the Fed tightens. And keep in mind, interest rates now, the Fed funds rate is only between 3 and 3.25%. So we haven't seen a return to what we might consider historically normal rates. Now, on a different note, student loan forgiveness, which we talked about here a few weeks ago, the rules have now changed. And again, if you have a comment or a question, I'll keep an eye on the questions box as I go through the material today. I am not seeing another question, so I will continue. But again, if you have a question or comment, go ahead and type it in the questions box. Morgan Smith wrote this piece on Friday, September 30. I put this in over the weekend. Over 700,000 borrowers no longer qualify for student loan relief. So we're seeing the rules change here. Hundreds of thousands of borrowers will no longer qualify for President Joe Biden's student loan forgiveness program, according to new guidance from the U.S. Department of Education. In a stunning reversal from previous guidelines, many borrowers who have federal student loans that are owned by private entities are no longer eligible for debt relief. As recently as yesterday, the site said they were working on a solution for these borrowers. Betsy Mayotte, president of the Institute of Student Loan Advisors, tweeted, "This is a gut punch to say the least." In August, the Biden administration announced the government would forgive up to $10,000 in federal student loans for those making less than $125,000 a year for individuals, $250,000 for married couples or heads of household, and up to $20,000 for Pell Grant recipients who meet the income threshold. Private loan holders are not included in the plan. So it's got to be a government federal student loan. Here's what the updated guidance now means for borrowers. Until Thursday, borrowers with privately held federal student loans qualified for relief if they consolidated their loans into the direct loan program. According to the new guidance, borrowers with FFEL or Perkins loans not held by the department can no longer obtain one-time debt relief through consolidation. They'll only qualify for forgiveness if they applied for consolidation before September 29. So now only if the federal government holds the debt do you qualify for relief. If it's privately held, you do not. Michelle Domino, who is director of education at Third Way, said this: about 4.1 million federal borrowers have 108.8 billion in loans held by private lenders. So she says it's not going to affect many borrowers. The change will not impact all 4 million borrowers with commercially held FFEL loans, as many also have a direct loan from the government that qualifies for relief, and others do not meet the program's income requirements. The department did not immediately respond to CNBC Make Its request for comment. Ultimately, 800,000 borrowers will be directly affected by the policy change. That's according to NPR. Now, Wolf Richter wrote this on his blog, Wolf Street. The Fed's favorite inflation index says that underlying inflation is just not slowing down. Not surprising. Again, you have to have real positive interest rates to get inflation under control. We don't have that presently. He says the Fed uses the core PCE inflation index released by the Bureau of Economic Analysis as yardstick for its inflation target. The core PCE index, which is the overall index minus food and energy components, is therefore crucial in the current rate hike scenario. Amid red-hot inflation, when everyone wants to know when inflation will finally cry uncle or be brought under control. Some folks thought that happened in July. There were a lot of politicians making victory laps at that point. We said not so fast. The core PCE inflation slowed down to 0% if you rounded the number down. Turns out that was an aberration. In August, the core PCE inflation index jumped by 0.6%, the same as the multi-decade records in June of 2022 and April of 2021. Underlying inflation is not slowing down, and those are words directly from Fed Chair Jerome Powell's mouth. Here's a chart that shows you month over month PCE inflation, and it looks at changes from the prior month. From 2020, you see that we've had a lot more volatility in inflation and a lot larger increases in inflation month over month. Now, core PCE is the most favorable inflation index the U.S. government provides, so it's not surprising, really, the Fed uses it. However, the Fed, looking at this, is saying we still need to hike rates. Now, as I have said in the past, I believe the Fed is going to capitulate. I think they'll go back to easing since they're not able to raise interest rates high enough to get inflation under control without creating even more problems like with pensions and government debt like the one we just talked about. So I think those problems are inevitable. I think we're just kind of watching the sand go through the hourglass here. Compared to a year ago, and if you take a look at the PCE price index excluding food and energy, you see where inflation has gone. The green line on the chart is the Fed's inflation target. The red line shows you where inflation really is. And we have seen year over year inflation actually just go through the roof. So I don't see us getting back to that 2% target with current policy here. Finally, the price of gas, a topic that we've all been thinking about this year. California, not surprisingly, is leading the nation in the cost of gasoline. In California, you'll pay double what you will in Texas, Mississippi, and Louisiana. Now, we have listeners from and viewers from all across the country on the Headline Roundup webinar. If you take a look, the red states are the ones where gas prices are between $4.16 a gallon and $6.36 a gallon. You see, that's the entire West Coast going from really Idaho south all the way into Arizona. You see the prices are quite high. Alaska, Hawaii, and Michigan are outliers, very high gas prices in those states as well. The dark blue states that you see, which would include Connecticut, as well as the Carolinas, all the way down through Georgia, Alabama, Mississippi, Louisiana, all the way Arkansas, all the way over into Texas, you see that gas there is from about $3.07 a gallon to $3.32. Varies widely depending upon policies and taxes. The national average gas price is $3.80 as of October 1. California at $6.36. Oregon is the second highest price. Mono County, California, the highest gas prices in the country at nearly $7 a gallon. That's what I have to talk to you about today. That gets us to just about 30 minutes. Exactly 30 minutes, actually, by my stopwatch. If anybody has a question, I'll be happy to hang around and answer any questions that anybody may have. And we have a question that came up here from Jeff. Is the difference in taxes the reasons for the discrepancy state to state? Largely, Jeff, although California has another initiative that I believe it's like a second tax moving toward the green energy outcome that they desire. So there's two taxes in California, and that likely could be pursued by other states that are looking, and yes, Jeff, Michigan is a high tax state. You are in Michigan, as am I. So I think we were back over $4 a gallon the last time I put regular gas in my vehicle. Premium gas, I believe, was pushing $5 a gallon. So Michigan is a high tax state if you happen to be watching this in Michigan. I think that's all the questions I see here. Again, a quick reminder, we will be recorded next week. We'll be live in 2 weeks. And I'm not seeing any more questions, Mark, so unless I've missed something, I think we can go ahead and conclude. Everybody, thanks for participating. Appreciate you guys getting the word out as well. Please feel free to do that. If you know of somebody that would like an invite to participate in this live, we'd be happy to get it to them. Just give the office a call. 866-921-3613 is the number. Be glad to get them an invite.
All right, we'll wrap it up there. Thank you, everyone, for attending today. Again, next week will be a recorded presentation, which, just so you know, is the same great presentation, just recorded ahead of time, and we won't be able to answer your questions live, but we'll be back live the following Monday, October 17. So we'll see you here for a recorded presentation next Monday. Until then, have a great week.